Welcome to the deep dive. We're diving into a whole stack of sources today, looking at something that, well, might be costing you quite a bit, maybe thousands, without you even noticing. It's often called stealth taxes.
Or the more technical term is fiscal drag.
Yeah, right, fiscal drag. And the key thing here is it's not about the government shouting about raising tax rates. It's quieter. It's about freezing the thresholds, the amounts you can earn or save or invest before tax kicks in.
And while those are frozen, inflation and hopefully your wages are going up.
Exactly.
Well-
Okay, let's unpack this then. What's our mission today? Simple, really. We need to pin down which allowances are actually freezing, get under the hood of how this quiet policy hits your wallet, and crucially, talk about what you can actually do about it. Proactive steps.
Absolutely. And look, this isn't just some theoretical exercise. It's very real. The Office for Budget Responsibility, the OBR, they put numbers on this.
Big numbers, I imagine.
Huge. They reckon freezing just the personal allowance, just that one thing, will pull, get this, 4 million more people into paying income tax by 2028.
4 million. Wow.
And on top of that, it pushes another 3 million people up into the higher rate tax band.
So 7 million people in total kind of nudged up the tax ladder simply because the goalposts didn't move with everything else.
That's it. It's a massive shift, but it happens slowly, almost invisibly. And the government, well, they expect to raise something like $42.9 billion from this by 2028.
43 billion without announcing a single tax rise.
That's the political genius of it, isn't it? You don't have to make an unpopular announcement. You just do nothing. Let inflation do the heavy lifting for revenue raising.
Okay, let's start with the basics then. This expanding income tax net, it seems to be catching more and more ordinary earners.
It really starts with the personal allowance. That's the amount of income you can earn before you pay a penny of tax. Our sources are clear. It's been stuck at £12,570 since way back in April 2021.
And it's staying there.
Scheduled to stay frozen right through until April 2028. That's a 7-year freeze, unbroken.
7 years. And when you think about what's happened since 2021, I mean, inflation has been, what, over 20%?
Easily. So think about someone on minimum wage or the living wage. They get pay rises, maybe just enough to keep up with rising prices, but those very rises push them over that frozen £12,570 threshold.
So they start paying tax on income that previously would have been tax-free just because the threshold didn't keep pace.
Exactly. It's ironic, isn't it?
Yeah.
Wage increases meant to help the lowest earners are partly clawed back because the tax system hasn't adapted.
Yeah.
It really shows you how stealthy this whole thing is.
Now, talking of stealth and, let's be honest, complexity. We have to mention the infamous 60% tax trap. This hits people earning a bit more. How does that work? It sounds brutal.
It is a bit brutal. It's not a headline rate. It's an effective marginal rate. It kicks in when your income goes over £100,000.
Okay.
At that point, the government starts taking away your personal allowance, the £12,570 we just talked about.
Right.
The rule is you lose £1 of your allowance for every £2 you earn over that £100,000 mark.
Right, so it tapers away. And that continues until
Your income hits £125,140. At that point, your entire personal allowance is gone. Poof.
So in that specific band, between £100,000 and £125,140, you're paying your normal 40% higher rate tax.
Correct.
Plus, you're effectively losing your tax-free allowance at a fast rate, which acts like another tax.
Precisely. You lose the benefit of the allowance, which is worth 40% tax on £12,570, but you lose it over an income range of just £25,140. That combination, the 40% tax plus the rapid loss of the allowance, creates that effective 60% rate on that specific slice of earnings.
Ouch. That's a real disincentive right there.
It certainly feels like one. A huge penalty for earning just over that £100K threshold.
And the net widens even more with national insurance, doesn't it?
Yeah,
NSEs.
same pattern. The main thresholds for employees, the primary threshold, that's also frozen at £12,570, has been since 2022.
And how does that play out for lower earners compared to, say, a few years ago?
Well, the stats show the impact pretty starkly. Back in 2015, that NIC threshold covered about 82% of what a minimum wage earner made. So most of their income is protected from NICs.
Okay. Fast forward to 2025. Projections show it'll only cover around 53%.
Wow, that's a big drop. From 82% down to 53%.
It's a huge drop. Nearly 30 percentage points less of their income is protected. So that minimum wage earner is paying significantly more in national insurance each month, purely because that £12,570 hasn't budged, while their pay has, quite rightly, gone up.
And we should probably mention the employer side, too. There was a change there as well.
Yes, the secondary threshold, that's the point where employers start paying NICs on their employees' wages. That was actually cut quite quite sharply, down from 9,100 pounds to just 5,000 pounds, starting April 2025.
So employers pay NICs sooner. That makes hiring more expensive.
Directly increases the cost of employing people, yes. And, businesses don't usually just absorb those costs. It likely filters through into the prices we all pay for goods and services. A bit more inflation fuel.
Okay, so before we move off income tax and NICs,
Yeah.
let's talk defense. If you're anywhere near that 60% trap or just want to minimize NICs, what are the go-to strategies the sources mention? How do you push your income down, technically speaking? Yeah, it's all about reducing your adjusted net income. The main tools are pretty standard financial planning techniques, but they become super important here. Number one, pension contributions. Putting more into your pension directly reduces your taxable income.
Makes sense. What else?
Gift aid donations. If you donate to charity and claim gift aid, that also reduces your adjusted net income. And thirdly, salary sacrifice schemes.
Like for company cars.
Especially electric vehicles, yeah, or cycle-to-work schemes, sometimes pension contributions via salary sacrifice, too. The money comes out before tax is calculated, so it lowers that crucial income figure. Really vital tools for navigating these traps.
Right. Useful stuff. Let's pivot then. We've talked about earnings from work, but what about money you make from savings or investments? These freezes are hitting assets too, right?
Oh, definitely. And sometimes in ways people really don't expect. The personal savings allowance to the PSA is a classic example.
That was brought in back in 2016, wasn't it? Seemed quite good at the time.
It did. 1,000 pounds of tax-free interest for basic rate taxpayers, 500 pounds for higher rate. When interest rates were near zero, that covered almost everyone's savings interest.
But things have changed a bit on the interest rate front.
Dramatically, with savings rates now hovering around, say, 4% or 5%, that frozen PSA is suddenly looking, well, pretty stingy.
How much savings does it take to breach it now?
Think about a higher rate taxpayer. They get 500 pounds tax-free interest. At 5% interest, you only need 10,000 pounds in savings before you hit that limit.
Just 10 grand?
Yep. Or maybe 11,000 pounds or 12,000 pounds at slightly lower rates. Any interest earned on savings above that modest amount gets taxed at 40%. So it's not just catching the super rich anymore. It's hitting ordinary people who've diligently saved a bit.
Okay. Is there anything else for savers?
Well, there's also the starting savings rate. That's a separate 5,000 pounds allowance, but it's only really for people with very low non-savings income, under 17,570 pounds. It tapers away quite quickly once your earnings go up, so less relevant for most.
Right. So the PSA is feeling the squeeze from fiscal drag. What about the dividend allowance? It sounds like that's had a tougher time.
A much tougher time. Assault might be a better word. It's been slashed by 90% since it started.
90%.
Seriously. It began at 5,000 pounds back in 2016-17. Nice and generous. Now, for the 2024-25 tax year and going forward, it's just 500 pounds.
Wow. 5,000 pounds down to 500 pounds. It's quite a cut over just a few years. What does that mean in practice? Who's paying dividend tax now?
Well, it means a lot more people are. The number paying dividend tax has jumped significantly. It's estimated at around 3.7 million people now. That's up from about 2.4 million just 3 years ago.
So 1.3 million more people dragged into dividend tax.
Exactly. And once you're over that tiny 500-pound allowance, the tax rates aren't trivial. They start at 8.75% for basic rate payers, then jump to 33.75% for higher rate, and nearly 40%, 39.35% for additional rate taxpayers.
Okay, so savers hit, dividend investors hit. What about capital gains tax, CGT?
Similar story, maybe even worse. CGT's been squeezed from both ends, the allowance has been hammered, and the rates remain relatively high.
Let's take the allowance first. How much has that been cut?
The annual exempt amount, the AEA, think of it as your tax-free profit allowance when you sell assets each year, has been cut by a massive 75%.
75%. From what to what?
It was 12,300 pounds back in the 2022-23 tax year. Pretty useful. Now, for 2024-25 onwards, it's just 3,000 pounds.
3,000 pounds, that's tiny. So if you sell some shares outside an IS or maybe a second property, you're likely going to pay some CGT now.
Much more likely, yes. That 3,000 pound threshold is very easy to breach with even modest gains. And once you're over it, the tax rates kick in.
What are the rates currently?
On shares, funds, most assets, basically, it's 18% if you're a basic rate taxpayer overall, and 24% if you're a higher or additional rate taxpayer. Residential property gains that aren't your main home are also taxed at those 18% and 24% rates now.
Okay, so again, let's talk defense strategies for assets. With allowances this low for savings interest, dividends, and capital gains, what's the obvious move?
The absolute number one defense is using your ISA allowances. ISAs are like a protective bubble. Anything inside growth, income, dividends, it's all completely free of income tax and capital gains tax. It's the main shield against these stealth taxes on investments.
So max out that 20,000-pound ISA allowance each year if you possibly can.
Definitely. And beyond ISAs.
What else can people do maybe before they sell something and trigger a gain?
Well, think about couples. You can often transfer assets between spouses or civil partners tax-free. This means you could potentially use both partners' 3,000-pound CGT allowances before selling. Doubles your tax-free amount, effectively.
Smart. Anything else?
And don't forget about losses. If you have investments that have lost value, selling those can create a loss that you can use to offset gains made on other investments in the same tax year. It's called crystallizing losses. Reduces your overall net gain.
Right, strategic selling. Okay, let's move into maybe the trickiest area, pensions and benefits. Lots of traps here, often hitting higher earners without them realizing. Where should we start? Maybe the MPAA?
Yes, the Money Purchase Annual Allowance,
Yeah.
MPAA. This one is crucial because it's a permanent change if you trigger it.
A permanent. Okay, explain. What does it do?
It dramatically cuts how much you can contribute to your defined contribution pension, your pot of money type pension, after you've started taking money out flexibly.
How big is the cut?
It's huge. Your normal annual allowance, which is currently 60,000 pounds for most people, drops right down to just 10,000 pounds per year.
60K down to 10-pound K. That's a massive reduction.
It is. And maybe even more importantly, once the MPA is triggered, you also lose the ability to use carry forward. That's where you could normally use unused allowances from the previous 3 tax years. That ability is gone.
So it really clamps down on future pension saving. Why does it exist?
It's primarily to stop people recycling pension money, taking tax-free cash out, and then immediately putting it back in to get more tax relief.
Okay, so what exactly triggers it? Because I know people worry about taking their tax-free cash lump sum.
That's the key point. The MPA is triggered if you take income using Flexi Access drawdown, or if you take something called an uncrystallized funds pension lump sum, or UFPLS, where part is tax-free, part is taxed.
But not if you just take the standard 25% tax-free lump sum and leave the rest untouched. Or maybe buy an annuity.
Correct. Just taking the tax-free cash element only and leaving the rest of the pot uncrystallized does not trigger the MPAA. It's accessing the taxable part flexibly that's the trigger.
So you need to be really careful about how you first access your pension pot if you plan to keep working and contributing significantly.
Absolutely critical. Imagine someone, maybe a business owner, takes just 10,000 pounds as a UFPLS to tide them over. They might think it's just a bit of cash, but bam, they've potentially capped their future pension input at 10-pound K a year forever. Big implications for retirement planning.
Right. Okay, another complex one for higher earners. The tapered annual allowance, or TAA. This also reduces the 60K pension allowance, right?
Yes, this one is aimed squarely at the highest earners. It can reduce that 60,000 pounds allowance progressively down to a minimum of 10,000 pounds. Same floor as the MPAA.
The rules seem fiendishly complicated, though. Can you break down who gets hit by this? There are 2 income measures, aren't there? Threshold and adjusted.
Yeah, it's a 2-stage test, and you have to fail both parts for the taper to apply. First is threshold income. Roughly, that's your income before deducting any personal pension contributions. If that's over 200,000 pounds, you move to stage 2.
Okay, stage 1. Income over 200 pound, ignoring your own pension payments. What's stage 2?
Stage 2 is adjusted income. This is basically your total income, including all pension contributions yours, and crucially, any made by your employer. If this figure goes over 260,000 pounds, then the taper starts.
So threshold income over 200 pound A&D, adjusted income over 260K. Then what happens?
Then, for every 2 pounds your adjusted income is over that 260,000 pound mark, your 60,000 pound annual pension allowance is reduced by 1 pound.
Down to a minimum of?
Down to that minimum floor of 10,000 pounds. So someone with an adjusted income of 360,000 pounds or more would see their allowance reduced to the minimum 10 pound.
Easy to get caught if you get a big bonus or pay rise and don't factor in your employer pension contributions correctly?
Very easy. Needs careful monitoring for high earners.
Okay, shifting slightly to benefits. The High Income Child Benefit Charge, HICBC. Another stealth tax, really, hitting families.
It definitely feels like one. Been around since 2013. Essentially, if one partner in a household earns above a certain amount, you have to start repaying any child benefit received, usually via the tax return.
The thresholds moved recently, didn't they? Gave a little bit of relief.
They did. From April 2024, the point where the clawback starts was raised from 50,000 pounds adjusted net income up to 60,000 pounds.
So a bit more breathing room?
A bit, but the benefit is still fully wiped out once your adjusted net income hits 80,000 pounds. It used to be 60,000 pounds, so the taper is gentler, but it still catches many families.
And the way to potentially keep some or all of that child benefit if your income is hovering around those thresholds.
Same tactics as avoiding the 60% trap, funnily enough. Pension contributions and gift aid donations. They both reduce your adjusted net income, which is the figure used for the HICBC calculation. So making contributions could effectively lower your income below the 80K or even 60K threshold and restore your child benefit.
Good tip. Any other key point on child benefit for families?
Yes, a really important one. Even if you know you'll have to pay the charge back because one partner earns over the limit, you should still make sure the lower earning partner or non-earning partner formally claims the child benefit.
Why is that?
Because the person claiming the benefit gets national insurance credits toward their state pension record. If they're not working or earning enough to pay NI, these credits are incredibly valuable for building up their state pension entitlement later in life. Don't miss out on those credits.
Crucial point. Okay, let's broaden out again. We talked about annual freezes, but some of these have been frozen for, well, decades, haven't they? Fiscal drag over the really long term. Inheritance tax, IHT, springs to mind.
Absolutely. IHT is the poster child for long-term fiscal drag. Receipts are soaring, hit a record 8.2 billion ALs in the last tax year.
Why the boom? Are rates going up?
No, the rates haven't changed in ages. It's purely down to frozen allowances failing to keep pace with rising asset values, especially property prices, over decades. More and more families are finding their states dragged over the thresholds.
And the main threshold, the nil rate band, the NRB, how long has that been frozen for? It feels like forever.
It almost is.
Yeah.
The main NRB, the amount each person can pass on completely tax-free, has been 325,000 pounds since, wait for it, April 2009.
2009, good grief.
And it's currently legislated to remain frozen at 325,000 pounds until April 2030. If that happens, it will have been frozen for 21 years straight.
21 years. Think of house price inflation alone over that period.
Exactly. And the extra allowance for passing on a main residence, the residence nil rate band, or RNRB, that's 175,000 pounds. That's also frozen until 2030. Though that one starts to taper away if your estate is worth over 2 million pounds.
That 325,000 pound figure is quite politically sensitive, isn't it? It feels like a number that should have gone up. If it had just kept pace with inflation since 2009, where would it be now, roughly?
Oh, easily well over 400,000 pounds, maybe even closer to 450,000, depending on the measure you use. The decision to keep it frozen has pulled vast numbers of quite ordinary estates into the IHT net. It brings in so much revenue now, it's become politically very difficult to unfreeze it, even though it catches people it arguably was never intended to catch.
So for IHT planning, given that huge freeze, what are the simple, immediate things people should think about?
It often comes down to using the annual gifting exemptions. Everyone has a 3,000 pound annual exemption. You can give away that much each tax year, and it's immediately outside your estate for IHT purposes. Use it or lose it.
Okay, 3K a year. What else?
Gifts out of surplus income. If you have income, you don't need to maintain your standard of living. You can make regular gifts from it, and provided they meet the rules, they can also be immediately exempt. Good record keeping is key there.
And larger gifts.
Larger gifts are usually potentially exempt transfers or PTs. Basically, if you make a gift and live for 7 years after making it, it falls completely outside your estate for IHT, the famous 7-year rule.
Right. Okay, final area of long-term freeze. The ISA allowance itself. The cornerstone of tax-free saving.
Yep, another one frozen in time. The total amount you can put into ISAs each year across all types, cash, stocks and shares, etc., has been 20,000 pounds since April 2017.
Since 2017, and that's also frozen until?
Scheduled to remain frozen until April 2030, same as the IHT thresholds.
Wow. Again, if that 20,000 pounds had just been indexed to inflation since 2017, what would it be now?
Sources suggest it would be north of 26,000 pounds by now. So every year, savers are missing out on about 6,000 pounds plus a potential tax-free savings capacity just because of that freeze.
And the absolute key thing about the ISA allowance.
It's strictly use it or lose it. You can't carry forward any unused allowance from one tax year to the next. If you don't use your 20K allowance by April 5th, it's gone forever for that year.
So consistency is key with ISAs. Any other minor frozen allowances we should quickly mention?
Yeah, just briefly. The trading allowance and the property allowance, those 1,000 pounds allowances for small amounts of income from side hustles or renting out a room, they've been frozen at 1,000 pounds each since 2017 too. And the marriage allowance, where one partner can transfer 1,260 pounds of their personal allowance to the other, that's also stuck.
Okay, so pulling all this together, the message seems pretty stark. Fiscal drag is real, it's widespread, and it's costing people money across income, savings, investments, pensions, and even inheritance.
It's unavoidable, really. Doing nothing, just letting things drift, means you will pay more tax over time. And potentially, you'll leave smaller legacies than you might have hoped. The only counter is being proactive. Regular review of your finances is essential.
So, what are those key review questions people should be asking themselves, say, every year?
I boil it down to four main ones. First, have I actually used my full ISA allowance and made the most of my pension annual allowance for this year? Use them or lose them.
Right. Number two.
Second, could I or should I be splitting assets or income with my spouse or civil partner to make better use of both our allowances like the CGT allowance or even income tax bans?
Good one. Third.
Third, specifically on pensions, if I'm approaching retirement but still working, should I think carefully about delaying accessing my pension flexibly to avoid triggering that permanent MPAA clampdown on future contributions?
Important timing consideration. And finally.
Fourth, if I know I need to sell a large asset that will generate a big capital gain way over the 3,000-pound limit,
Yeah.
can I perhaps phase the disposal over 2 tax years to use 2 sets of annual allowances, spreading the gain?
Excellent practical questions. So, wrapping up, what does all this really mean? It feels like you have to constantly run just to stand still with the tax system, even when politicians say rates aren't changing.
That's a good way to put it. The silence, the inaction on thresholds, is the policy. And it's a very effective policy for gradually shifting wealth from individuals and families to the government coffers without big, unpopular announcements.
But digging through our sources, there was one fascinating little exception, wasn't there? Almost all allowances frozen, but one saw small increases.
Ah, yes, the blind person's allowance. It's one of the very, very few allowances that has actually crept up a bit in recent years. It went from 2,600 pounds a couple of years ago to over 3,100 pounds now. Small increases, but increases nonetheless.
So here's the final thought for you to ponder this week. What does that tell us? Why might that specific allowance receive indexation, however modest, while fundamental thresholds like the IHT nil rate band remain frozen for potentially over 2 decades? What does the government's choice about which allowances to freeze and which one to nudge up slightly reveal about its priorities, or perhaps what it thinks is politically safe when employing the powerful silent tool of fiscal drag? Something to think about.